What's up, everyone? I'm here today with a video that a lot of people on my channel have requested for some time, and I'm not sure how well it's going to go over standalone, but we're still experimenting here, so let's see. The topic today is stock options for dummies, and that's not my word, that's people who have commented, and it's, a play on the old computer books for dummies, basically for people who are interested in a topic and want a quick brain dump. So that's what I'm going to try to do here. I can talk about this stuff at length indefinitely. I will try to make it as short and concise as possible. If you're new to options, they can be daunting because they're not really explained anywhere. If you use a trading platform, you can click around and it doesn't necessarily make a lot of sense if you've never seen or worked with them before. So stock options are basically a leveraged derivative, and there are call options and there are put options, and call options give the purchaser the right to buy shares at a certain strike price. So as an example, and I'll give you a real world example here that I'm working with, I've got my little cheat sheet of my data right here. The company is Fate Therapeutics, and I have traded options on both sides of this, calls and puts, because it's a company that I like, but I don't honestly care for the current valuation, so I'm not looking to accumulate, I'm just looking to make money on this stock. So the stock right now is about $84, and a call option on this stock at the nearest out of the money strike, which is the $85 strike for August 20th, 2021. Today is currently July 23rd, Friday, July 23rd, so about a month away, 28 days away to expiration. The $85 call costs $5.70. That means that as a buyer, you would pay $5.70 a share for the right to buy this stock at $85. So if you add those two together, that's your entry price. You're basically looking at needing $90.70 within 1 month for you to even break even on this trade if you are a buyer. So that's pretty expensive, but that's also kind of par for the course with a stock that is in a volatile space that has potential for huge returns. If you know the catalyst, it's possible a stock like this could double overnight. So if you make a trade like that and you succeed, you can make out like a bandit. Oftentimes on the internet, you'll hear stories about people who have hit the jackpot or the lottery. I think of options, if you're a buyer, as going to the casino. The house usually always wins. You hear the stories about the people who are mega successful, but the majority of times the house wins, you're a loser. The cool thing about options is you can choose to be the house. If you are a seller, which is where I find myself the majority of the time, you're effectively the house and you're just making money month after month. So, even just talking about this here right now, I've realized this can get very long very quickly. I can try to do an extended brain dump of this, but I'm gonna try to stay on track here. So, there are calls which give you the right to buy shares at a certain price, and there are puts which give you the right to sell shares at a certain price. So options are not inherently bullish or bearish. You make that decision with whether you trade puts or calls, and again with whether you buy puts or sell puts, or buy calls or sell calls. There's a lot of options here. So if you are bullish on a stock, you would sell puts because you believe that they'll expire worthless, or you would buy calls because you think that the stock will go up. If you are bearish, you would buy puts because you think the stock is going to go down, or you would sell calls because you think the stock is not going to stay above a certain price and therefore the calls would expire worthless. I tend to only sell options. If you look at the trades that I've made around Fate, I basically only sell. I sell puts. I hope that they expire worthless. If I end up getting the shares, I will flip and sell calls against them. So if we look at a real example that I've got here, I've got all of the trades that I've made against Fate this year right here, and I'll throw it up on the screen. I had sold puts in June for $70 and $75 and $80. And I also sold puts in May. So I have at risk here. I show how much I have at risk with each one. So options trade in quantities of 100. So I sold June $70 puts, 3 contracts. That means 300 shares. I put at risk $21,000 and I made $1,026. If I look at all of the trades that have closed out, and all of these actually basically expired worthless, meaning I sold puts at a certain strike price that was below the current price, and the stock stayed above the strike price, so the options, the put options, expired worthless, and I captured the premium, I made $2,707 against $103,500 that I put at risk. Now, I do math on this, but it's kind of hard because some of these options, when I look at when they were opened and closed, they were only open for 3 days. So it's really hard to extrapolate some contracts that were open for a month or two and combine that with some that were open for a handful of days. But what gets interesting here, I think, is this lower bit. And this is what's currently active for me. So for the month of July, I had sold 3 different put contracts against Fate. 2 were at $85 and 1 was at $80. And at options expiration, which was July 16th, options, by the way, generally expire the 3rd Friday of every month, although there are plenty of stocks that actually trade options on a weekly basis, and they would expire at close on Friday in general. The stock at option close was $79, which means I was on the hook for purchasing 300 shares of Fate. Now, the blended price accounting for the premiums that I captured across these 300 shares was $80.05. So I basically had an entry into Fate for 300 shares at $80.05 for a total cost of $24,015. The interesting thing about that entry is that when I made those trades, the stock was trading above 85, which means at a time when the stock was above 85, I made a decision that ended up getting me an entry at $80. That shows you kind of the power of the premium that you can capture, and it gives you a sweetheart entry even if you do end up getting stuck with it. So I think in general, you have to be careful about not going overboard. Having access to leverage can be dangerous because it can potentially put you in a situation where you're in over your head. But if you use the leverage and you're comfortable with what's going to happen, in this case, me needing to front $24,000 to purchase 300 shares, then it actually gives you a better entry than you would have gotten otherwise. So now, presently, right now, I hold these 300 shares, and the very first day, the Monday after options expiration, I sold 3 contracts for Fate at $85, 3 call contracts for a $5.34 premium. So my hope is that come options expiration for August 20th, that the stock is over $85 and I sacrificed the shares for $85, but I captured the $5.34 premium, meaning if the stock is over 85 on August 20th, I will have an exit for the 300 shares at $90.34. That means my profit will be $10.29 per share, or $3,087 over a 2-month span, which extrapolates to about $18,500 per year, or a 77% return against the $24,000 on an annual basis. That is an incredible return. That is part of why I do what I do. It's an element. Generally speaking, I actually am a buy and hold investor. I pick things that I like for the long term and I just accumulate indefinitely. This is an example of a way that I can make some spending cash on the side, just keeps things interesting. It's proof that you can use stocks to generate passive income, which is not something that I hear people talk about regularly. A lot of people, when they think about passive income, they think real estate or some sort of a side business, but not using equity investments to generate it. And you absolutely can if you use options as the mechanism. In general, I do not like buying calls. I do not like timing investments. The market will do what it's going to do irrespective of what you think. I have seen people lose entire life savings, 7 figures, thinking that they were smarter than the market, that they knew something was going to happen, and in some cases even getting their way and having the market react in a different fashion. There is a thing called max pain. It is real. If you look at the open interest on a strike for options expiration and you see a lot of open interest, heavy volume, that typically will represent strong resistance. So as an example, with Fate, if the highest open interest was at the $90 strike, I would not recommend buying that call because the odds are at options expiration, it will stay underneath that price. It's almost a way of predicting the future by just looking at this. I would say 90% of options expire worthless. It's a number I've heard batted around. I've generally found it to be true in practice with all of the stocks that I've worked with. And so knowing that can give you your strategy of basically selling these options that are likely to expire worthless and therefore capture the premium. When it comes to this stuff, it's kind of interesting. The balance of how much you should try to take now versus later is something where I've made mental demarcations in my head. I have things like Fate where I'm willing to trade around immediately because I think it's a good company, but I think it's honestly valued too highly right now, so I'm not interested in buying and holding for the long term. And I am willing to sell calls against it. Alternatively, I have positions where I could be making very similar returns by selling calls on a monthly basis, but the potential there is so high that I refuse to do it. And there's an opportunity cost associated with that, because if I did this exercise this morning, if I were to sell the nearest out of the money call against all of the stock that I own, I would make over $30,000 in 1 month, and the stocks would have to go higher than these strike prices for me to actually lose the stock. So I'm giving up $30,000 minimum every month just to sit on these long-term positions because I think the reward there is even higher than that. The interesting thing about that is that's actually on the low side. I would say things are kind of quiet right now at the moment. I've seen that number as high as $70,000 before. So somewhere between $30,000 and $70,000 I could be making in passive income every month if I sold out of the money calls against my entire position. And being out of the money means that if the shares get taken, I'm actually making a profit to what I would have made on the day that I sold those contracts. I just kind of want to illustrate with this video that equities can be an incredibly powerful wealth generating tool and passive income generating tool. I have kind of sunk my teeth in and really dug into this space for the past probably 15 years, if not more. And I'll be perfectly honest, the great irony of this is I actually do think real estate has almost proven to be better. I think that the ceiling on the potential with how I'm currently positioned is higher than any other route. If you look at people like Elon Musk, Jeff Bezos, people who become truly wealthy very quickly and very easily, I mean, in terms of how the money gets generated, it's all concentrated positions in equities that grow because you basically have a business and people working every day to add value, right? Your team, when you buy a stock, you actually have this company, these people, as if they're trying to generate wealth for you. That's something that I think is lost on people. They don't necessarily do the translation of, I bought this stock means that I own this company. I think they look at it as an opportunity to enter at a certain price and hopefully exit for more. I view my positions as owning a business that hopefully will generate real world value to humanity over the long arc of time, and that will eclipse any other possible investment I could make. So that's how I've positioned myself, but the irony is we own a couple of houses in the Bay Area, and the amount of equity that's been generated by sitting on these houses doing nothing has really kind of been absurd. And additionally, one of the houses is a rental and it's making strong cash flow positive passive income every month. And I don't want to say it was accidental, but it certainly was not as deliberate as the equity investments that I make. So both are viable avenues. I think having balance across types of investments can be a good thing. I've gone on way too long already. If you watch this, if you like it, please drop a comment, let me know, like and subscribe. I want to make more of these. I want to make them in a way that's useful to those out there who are watching this. Like I said, you can probably see it here, I could go on forever about this stuff. So I'm going to cut it here. Let me know what I should do next. I appreciate you. Thanks for watching. I will see you at the next one.